Apple just got an upgrade on its stock. But before you get too excited, this isn't your typical Wall Street stamp of approval. In fact, it's more like a cautious thumbs up, and the story behind it says a lot about where Apple, and maybe even the whole tech sector, could be heading next. So here's what happened. Jefferies, one of the big investment banks, just shifted its rating on Apple's stock to hold. Now, in Wall Street lingo, an upgrade often means a company is moving up in the world. But in this case, it's a little more complicated. Instead of saying Apple is a screaming buy, the analyst is basically saying, yeah, they'll probably be okay. Not much better, not much worse, just stable. If you're an Apple fan or a shareholder, that might sound underwhelming. Let's dig into why. Apple has long been seen as the gold standard in tech. Iconic products, loyal customers, massive profits. For years, their stock seemed unstoppable, with the company regularly topping lists as one of the most valuable in the world. But lately, there are a few clouds on the horizon, and this latest hold rating reflects a more cautious mood. One of the big worries is tariffs. The analyst at Jefferies called out concerns about the impact of possible tariffs on Apple's products. Now, tariffs are essentially taxes on imported goods, and in the last few years, they've been a major point of tension between the US and countries like China. Apple, as you probably know, builds many of its devices in China and then ships them around the world. If the US government decides to impose new tariffs, or if existing ones get tougher, then Apple could either eat those costs or pass them along to consumers. Neither option is great for profits or for buyers who don't want to pay even more for their next iPhone or MacBook. This isn't the first time tariffs have been a worry for Apple. Back in 2019, during the height of the US-China trade war, Apple's CEO Tim Cook even met with President Trump to discuss the impact of tariffs on the company. At that time, Apple managed to avoid the worst of it, but the threat has never fully gone away. And with global politics still in flux, the risk is real. The Jefferies analyst also pointed to concerns about Apple's future sales.
For years, Apple has defied gravity with one blockbuster product launch after another. But lately, there's been chatter that the magic might be fading. iPhone sales, for example, have started to slow down, not fall off a cliff, but definitely not growing at the breakneck pace investors once expected. In the last few quarters, Apple's revenue from iPhones, still its biggest moneymaker, has either stalled or inched up only slightly. Some of this is due to market saturation. Just about everyone who wants a smartphone already has one, and they're holding on to them longer before upgrading.
Meanwhile, competition is heating up. Companies like Samsung and a whole slew of Chinese phone makers are coming out with devices that rival Apple's, often at lower prices. In China, which used to be a huge growth market for Apple, sales have stumbled as local competitors gain ground. And let's not forget about the rise of good enough tech. Devices that may not be as flashy as the latest iPhone, but get the job done for a fraction of the price. Apple has been trying to pivot away from relying so heavily on hardware sales. That's why you're seeing so much emphasis on services. Things like Apple Music, iCloud storage, and the App Store. In fact, services are now one of the fastest growing parts of Apple's business. But even that isn't bulletproof. Regulators around the world are starting to take a closer look at tech giants' business practices, especially when it comes to app stores and fees. That could mean more legal battles, or even new rules that eat into profits. So, what does a hold rating actually mean for investors? In essence, the analyst is saying, the stock probably won't crash, but it's also unlikely to soar in the near future. Think of it like a car in neutral, moving, but not really accelerating. For Apple, that's a big shift. This is a company people used to buy for its constant outperformance. And now, expectations are being reset. But let's get real. Apple is nowhere near crisis mode. This is still a company sitting on a mountain of cash, with billions of users and a brand that commands fierce loyalty. Even if growth slows, Apple has options, They could double down on new technologies like augmented reality, health tech, or even electric vehicles, areas where they've hinted at future plans. Apple has a history of reinventing itself when it needs to, and few companies are better at turning challenges into opportunities. Still, the message from Jefferies is clear. The easy money days might be over, at least for now. Investors, especially those looking for quick gains, may need to temper their expectations. That doesn't mean Apple is a bad company, or even a bad investment. It just means the road ahead might be bumpier, and the rewards a bit harder to come by.
So, as we watch to see how Apple navigates these challenges, tariffs, slowing sales, and rising competition, it's a good reminder for all investors. Even the biggest, most successful companies hit speed bumps, and sometimes holding steady is an achievement in itself. The real question isn't whether Apple will survive, but what it will do next to surprise us all. Will they launch the next must-have device, or will they reinvent the tech landscape once again? Only time will tell, but one thing's for sure. In the world of investing, even a hold can be more interesting than it seems.